Interesting note that Morgan Stanley has written to its clients today. They have written very deeply and they have gone in depth into the entire cement cycle of India. They believe that the Indian cement industry is beginning a new cycle, and they advise playing the cycle rather than focusing on near-term cement price movements. They say that they would be using the share price volatility that we are seeing to actually accumulate select stocks. As per Morgan Stanley, their key picks are Ambuja Cement and Ultratech Cement. They have raised the target price for Ultratech Cement from 6,300 to 8,000 rupees a share. Ambuja Cement, they have raised the target price from 325 to 360. Dalmia Bharat, they have raised the target price from 1,050 to 1,300. Grasim, they have upgraded this particular stock from an equal weight to an overweight. Their earlier price target was 966 and now their price target is 1,700. Shree Cement, they have downgraded, and ACC as well, they have downgraded. Now, Shree Cement, they have downgraded from an overweight to an equal weight stance, while ACC, they have downgraded from an equal weight to an underweight. Now, what they are saying is that they are reiterating their attractive industry view with above consensus FY23 earnings estimates and price targets. They expect broad-based and above average demand growth of 9% annually over FY21 to FY23, and they see margins holding up on a 2-year basis despite they are expecting a dip in FY22. They have also raised their FY23 earnings estimates up to 13%, driven by better realizations and margin assumptions, and they say that they are significantly ahead of consensus. Valuation as per them, especially on an EV to EBITDA basis, is not cheap for the entire Indian cement space. But they say with improving growth visibility and return ratios, multiples generally will tend to overshoot long-term averages. They say that investors' focus should shift to 2-year forward EV to EBITDA and free cash flow yield of 4.8% for the cement industry in general. They say that is still quite attractive and reasonable. They have raised their target price almost 7%, 11% to 76%, and the target price for cement companies are amongst the highest that within the street itself. Now, what they are saying is that what drives their very high conviction as far as FY23 margins is concerned. Remember, margin worries is something that a lot of analysts on the street have alluded to on the back of the fact that coal prices as well as petcoke prices have been on a downswing. They say that regional clinker supply analysis suggests utilization rates are reaching almost 80% in FY22 across most regions, barring the south. They are saying that this implies peak utilization rates of 85 to 90% in seasonally strong quarters, supporting strong price increases. They are saying that cost inflation generally has been passed on by the industry in the form of higher realizations, and also what they are saying is that cement realizations typically have moved in line with the WPI index. So what they are saying is that overall the cement industry in India is looking very attractive.